So first we'll look at the historical numbers on where do we stand right now in terms of the price to earnings ratio, price to book ratio versus our own history. And when you look at these charts, you will find that the Nifty index, which is the large cap index, has more or less reached the long term average, the 20-year average for price to earnings ratio. And please note that these numbers are skewed. And this time when I put these numbers, they are not adjusted for the variation between standalone and consolidated. And there was a question yesterday on what is the impact of standalone and consolidated numbers. So prior to 2018, most of the data that you see for most financial companies was reported as standalone. And all the earnings, etc., whenever they were reported as standalone numbers. Very few companies reported consolidated numbers on their own. And then they were asked to report consolidated numbers. And after COVID, NSE also started to report the consolidated price to earnings ratio for Nifty. So from a standalone, it went to consol numbers. So whenever this transition happens from standalone to consol, the consolidated price to earnings ratio is always lower than the standalone number. So when you look at this number and when you look at the history, had we taken the full consolidated number, this average multiple would have been even lower. Right now it shows 20, but if you take a consolidated series, if you go back in some issues of Netra, we've shown a long-term consolidated price to earnings multiple also, which we have recalculated by going back in time. So when you look at that average, you will find that average will be close to 18 and a half times. It will be lower than the 20 average, which is visible on the screen right now. So that is one of the impact that when you move from standalone to console, the overall number will come down. So the average that we see today hides this fact.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.